Hello, everybody. I'm your host, Eric Bird, here at StopStrugglingNow.com. And today we're going to talk about how is it that Donald Trump could only pay $750 in taxes, not 1 year, 2 years? We're going to talk about it. It's possible, ladies and gentlemen, and I'm going to show you little tricks of the top 1%ers, top 10 percenters. This is why you want to be a top 10 percenter. And welcome to Foci Optics. Check. Stop struggling now gear. Check. And please like, subscribe, and click the bell below so you get the latest updates. Now, let's get to it. All right, welcome back. And as you can see, we're on the YouTube Stop Struggling Now channel. And I want to thank everybody because we done hit 7,000 subscribers. This is pretty awesome. And please share the videos. This can help other people, especially about today when you're starting your business. And we're talking about taxes. And we're going to be talking about what else? The Donald Trump taxes apparently only paid $750. And some of you may say it's impossible. Well, we're going to talk about it. And as I always say, notice there's a join button over here on the right hand side. If you'd like to support the channel, please join us as a member. And I give special messages under the community tab, 1 or 2 videos a month under the community tab, just for members only. And it would be an honor and a pleasure if you became a member. Now, I'm going to go to the page. As you can see, all over Google, social media, is the talk about Trump paying $750 in U.S. income taxes in 2016 and 2017. I'm about to show you some things on how it is quite possible. But keep in mind, you must have an accountant. In fact, in his case, you must have several accountants. And not only must you have several accountants, you're going to have to rack up losses in corporations, in LLCs, in order to offset paying a little amount of $750 in taxes. This is why you guys, once this comes out, you will see more than likely that he's not going to have 5, 6, 10, 20, 30, 50 subsidiaries of companies, but try to rack up, get your mind wrapped around hundreds of LLCs and corporations and offshore corporations and even trust, because trust can actually hold the assets of a holding company. So we're going to get into all of this today. This is going to be exciting, but I am no financial advisor. I am no accountant. I'm no tax advisor. So therefore, you will have to consult a tax accountant or an advisor to make sure some of these things can work out for you. And I'll end it with a caveat, but not right now. All right, I'm here at the StopStrugglingNow.com page. And as you can see, we have merchandise. We actually sell merchandise. And as you can see, if there's a Stop Struggling Now LLC, there could be a subsidiary for the merchandise as a separate entity. So now Stop Struggling Now LLC is a holding company. Subsidiary is SSN Merchandise. All right? That's how you would do it. All the money made from the shirts, I can pass up to the holding company. If I have the holding company under an LLC or an SCorp, it all depends on how you're going to be paying some taxes. All right? So we're going to get into all of this. I just want to get you a little understanding, and we're going to start talking about some tax advantages. 6 strategies to protect income from taxes. This is not the Donald Trump way, but I just want to give you guys some heads up. I'm going to have a link down below to Investopia here, so you can Investopedia, so you can see this page for yourself. I'm just going to go over it briefly based on investing municipal bonds. There's a reason they pay lower interest rates, so the tax benefits, tax equivalent yields, you'll have to look into that. Another way, shoot for long-term capital gains. long-term capital gains. Let's say, for instance, you buy stocks. If you sell your stocks within 1 year, if you have a profit, you have to pay 25% in taxes, capital gains tax. Now, if you hold it for more than 1 year, look at here. An investor holding an asset for longer than 1 year either pays 0, 15, or 20% on the capital gain, and it's going to depend on your income level, ladies and gentlemen. So if you claim that you only got like $30,000 this year, you're going to be paying 0% capital gains tax after you hold the asset for 1 year. This holds true in most assets that causes a capital gain, such as real estate. All right? That's why when you flip real estate, this is why real estate works a little bit differently, because you can, instead of paying tax, you can actually buy property with your profit, which now means you have not accepted the money, so therefore your tax could be lower, and you pay it down the line. You can do this with the 1031 exchange. All right? And you can do that with regular properties, and this is why people have holding companies, and then they have a separate LLC for each individual property. All right? We still haven't gotten to the Donald Trump situation. And of course, in order to take advantage of tax deductions, you have to start a business, as number 3 says here. All right? Oh, and by the way, a lot of you are have your businesses in your home. There are deductions for home expenses. In fact, if you have an office, you can deduct the square footage. Based on the square footage of your office and your square footage of your house, that percentage you can deduct on your tax, for instance. Okay? Internet bill, you can deduct portions. Cell phone bills, of course. Utilities, again, because your business is using electricity, you're using gas, you're using internet lines, potentially, telephone lines, potentially, Wi-Fi, all right? These can all be deducted. If you do not place your business under an LLC at least, then you will not be able to deduct those expenses. So there's some of the things right there. So let me give you an example. Let's say I live at Mar-a-Lago, but I bought Mar-a-Lago under an LLC. I don't live there, right? So now I bought it under a business name. It generates itself, but since I am the owner of the LLC, then I can come and go as I please and live there. But it's a tax write-off because I have it under a business. This is how it's done, ladies and gentlemen. Be a top 10%er. Try to be a top 10%er, but you're going to need a tax professional to help you navigate through all of this. Here we go. Max out retirement accounts. Again, this is where I will start with the Donald Trump will have a problem, because there are maximums that you can do for losses, maximums you can do for taxable income with retirement accounts, as you can see here. For 2019, taxable income can be reduced $19,000 when contributing to a 401k plan or 403b. 2020, $19,500. Those 50 and older can add $6,000 to the basic workplace retirement plan. So as you can see in their example, if you made $100,000 and you contributed $19,000 to a 401k, do you hear me, ladies and gentlemen? You can set up a 401k, your own style 401 or IRA. Get this, even with stocks, ladies and gentlemen, your contribution is tax deductible. So that $100,000, you minus the $19,000, you only are going to be taxable on $81,000. If you work at a job, this is why some of your coworkers are trying to put up to $19,000 in their 401k, because when that tax bill comes and says they want based on 100,000, you might have to pay 25,000 in taxes. But now, because you put $19,000 into your 401k, you get it down to 81,000, and your tax bill might only be $19,000. This is how you do it and reduce it. But this has nothing to do with Donald Trump, but we're talking about you, the ordinary citizen, the OC. Hopefully this gets you excited so you get yourself into the top 10%er game. You have to know taxes and you have to understand this. Don't be like a person that says, well, I don't want to learn it. I'll just be a W-2 guy. Well, the W-2 guy, he's sitting there paying a hell of a lot more taxes than you or I or Trump will ever pay. Meanwhile, they're siphoning off your wealth. So here you go. We'll keep going down the list. Use your health savings account. Some of you have high deductibles. Some of you have health insurance. Again, look into it. This can be written off. But again, they have a maximum contribution, and it's $3,000, $3,500. That's it. A family can do more to double it, so around $7,000 for a family. And the money grows without requirement to pay tax on earnings. That's called an HSA, ladies and gentlemen. Again, you start adding all this up, you start finding out that you right now could have missed out on your 2017, 2018, 2019 tax situations, but you can go back. Hopefully everybody knows you can go back and amend your tax returns. Just letting you know. Get IRS credits. Here we go. A lot of people know about the earned income tax when you have children and certain levels of taxes that you have. I mean, certain level of income that you can get an earned income tax credit. See, here's the thing. For Trump, he should not be getting an earned income tax credit. Probably wouldn't be. But again, these are the kind of things that an ordinary citizen can take advantage of. All right? Now, let's get into how Donald Trump is doing it and all the other wealthy guys, because you want to be a top 10%er, and when you get there, next stop, 1% territory. All right? So here's how they do it. A holding company. How a lot of you have heard about it. The holding company, I've talked about it briefly. A holding company can be an LLC. Now, I used the example at the start of this video. This video is going to be a little lengthy, ladies and gentlemen. So I suggest you get some popcorn, you get your water, you get your mixed drinks, whatever you want to do, sit back and relax. Because this right here is the reason why you want to have LLCs with a plural at the end, and you want to have a structure where it's set up similar to what you see on the screen. This actually is a setup for the state of Florida. And it's from Allen Roman law. But anyhow, this is set up almost for every state or every state in the United States of America, and in most countries, this is what you do. Everybody knows Warren Buffett, so we'll just say Berkshire Hathaway. This is what they do. Every company they buy, it turns into a subsidiary, and that's why, how do you own a subsidiary? You have to own like 80% or more of the voting rights and be management. So that means you own it. So when they buy a company, that's what they do, if not 100%. You can own 100% as well. But you got to be 80% or more. So that's how they control the companies. They own them that way. They control the management. They even can leave the management in place. But the way they set it up is they have controlling voters' rights and information. So therefore, they can almost make all decisions without anybody else. So anyhow, let's get down to it. Like I mentioned, Pretend Holdings LLC is StopStrugglingNow.com LLC. All right. Let's go down here. Like I used the example, this active business is going to be Stop Struggling Now Gear. All right. Intellectual property could be YouTube channels, Instagram, TikTok, Facebook groups. You're getting it so far. These could be separate entities because you want to operate and have income coming in from each separate item. All right? high liability assets, and in this case, in this example, we have investment property. So you have to understand that now the holding company owns all four of these entities. All four of these entities are operating by itself, and that infamous what if I get sued scenario, that can happen. So if somebody sues investment property over here and you don't want to pay, as in, let's just face facts. Let's keep it real. Donald Trump, since I'm talking about it, let's get real. Donald Trump, perfect example. He gets sued, so instead of paying the money, he'll file this investment property company as a bankrupt company. This is how he has bankruptcies. He does not have any personal bankruptcies because remember, this is an entity. This is not personal. Unless, of course, you're trying to do a personal guarantee. He has none of that to do with these LLCs that he's forming underneath his holding company. And I'll get into something else that's very interesting for tax write-offs and tax havens. But we're going to deal with this, what you see on the screen. So this investment property, somebody trips, breaks their neck, family sues you. What happens? Fine. I'm going to file bankruptcy. F it. I'm going to add somebody else to the list. Jay Morrison. Yeah, that guy. He done the same thing when somebody tried to sue him and he owed money too. So these LLCs can be dissolved and people can file bankruptcy within their LLCs to avoid paying people with lawsuits. All right? Just letting you know. That's how easy it is when you have a holding company. And what do you do next? They go out and open up another LLC under a different name, which is now a separate entity with another EIN number, with another DNB number. Are you getting the picture? So this also has liability protections built in when you structure your holdings like this. All right? I'm just setting this up for you. So this is how Trump sets his up. This is why when it's all said and done, he will have 300, it's going to be 300, 200, it's going to be some ungodly amount of LLCs all distributed, winding about within each other. And the reason why I say that is in order to pay that small amount of taxes is because each LLC earns income. Now, how I distribute that income is another thing. When we have a profit, let's just say now I get a fifth property. And if I'm wealthy, most of you will have seen a situation like this, Walmart. How many times have you seen a Walmart that used to be in one location and then they moved Walmart to another location and you're sitting there going, why is that Walmart still empty after 5 years? How come nobody or no new company has moved over there? Well, you want to know why, ladies and gentlemen? Because Walmart is still paying the lease on that building. And what does that lease, when they're paying $25,000, $35,000 a month? That is a loss, ladies and gentlemen. Are you getting the picture yet? So therefore, if I pay $30,000 a month on a property, that's $360,000 loss. And I did it to myself, but it's because I need to offset profits that my holding company will have to absorb. So now I get to subtract $360,000 from our profits from the other companies, in essence, all total. So when you do this 3-4 times, you buy multi-million-dollar properties, and now you get something called depreciation over time, which is another trick that Donald Trump has used. Not only him, but the wealthy. This is how corporations do not have to pay. And in fact, this is why corporations are always looking for new headquarters, new places to move after X amount of time, because it behooves them under our tax code. Once your depreciating asset runs out, then you cannot count that against your profits. So what do? Well, we need to go to a bigger headquarters. There we go. Are you getting it yet? Do you want to be a top 10 percenter and pay less taxes? These are all legal under the IRS tax code. And America's the United States of the corporation United States of America, you who has a social security number, you are being monetized by the United States government as long as you work under a W-2 format. But when you get an EIN, you are now a subsidiary of the United States of America Corporation. And therefore, you have joined in the party to be a top 10 percenter. Come on now with me, ladies and gentlemen. Let's see, what else can we do here? We're going to talk about some other tax advantages. Here we go. Check this out. The holding company. You can just Google this yourself, tax advantages for holding company, and you'll see if there are multiple companies nestled under a holding company, it may be possible to file a single consolidated tax return, which can result in a lower tax liability overall. This is what you will see if his tax returns, that is Donald Trump's tax return. In fact, it doesn't matter about him, although he's president. But Amazon, Google, Apple, they're all going to have this similar structure. Okay, Berkshire Hathaway. Now, additionally, a subsidiary company can generally pay dividends to its holding company tax-free. Do you see this, ladies and gentlemen? So now you have a situation where you have a corporation, S corporation potentially, you can pay dividends to your holding company that you own, and it's tax-free. Are you getting this yet? I can pay myself $1,500 a month, claim that that's my salary. I can send dividends up to the holding company and say, well, we're sending him because they own 100% of the company. Our profits were X amount. We're going to send up $3,000. All right. Hopefully, I'm illustrating this so you understand what I'm saying. Let's move along. I'm going to keep going. Once your LLC is taxed as an S corporation, okay. So here we go, ladies and gentlemen. LLC is not an S corporation. Disregarded entity is an LLC. For tax purposes, you can change your LLC to an S corporation. Now, you don't want to be an S corporation starting out. You want to have money coming in. And in reality, you probably want to be making money. You probably want to be around 40, 50K a year at least. All right? I wouldn't suggest somebody do it if you're only having your LLC only do like 25 G's or anything like that. But once you get around 40, 45, that's the equivalent of around $4,000 a month through your LLC, then, and you're going above, then you want to do an S-Corp. The reason why, this is similar to what Trump is doing, because if you are under an S-Corp, I'll put it right here, you're only going to pay 15.3% self-employment tax. And as you can see here, they illustrate your extra money left over called distributions is not subject to self-employment tax. Are you seeing this, ladies and gentlemen? Hopefully you're seeing this. So you understand, once you declare that you're going to be an S-Corp, you do have to file and let the IRS know you're going to be an S-Corp. And you have a certain amount of time during the year to do it. And then once you claim S-Corp, then you're an S-Corp and you keep going. But now you only have to pay 15.3% on a self-employment tax on your salary. So remember that $1,500 that I was talking about of my salary? Well, I only have to pay 15.3% self-employment tax. And self-employment tax, in case you don't know, goes for your Medicare and Social Security, by the way. So that's how you pay a lower percentage. A lot of people, when Mitt Romney was running, they got upset because they found out he paid 12 to 15%. I can't remember the number, taxes. And I said, of course he did. after it's all said and done, this is what he did. It's pretty simple. All right, he didn't want to go through the fact of running around trying to get like 100, 200 LLCs under his company. That's all. But he could have got it down to almost zero as well if he wanted to. All right, let's move along. Hopefully this is working for you and you understand what I'm saying. Put a comment down below if you understand this. And if you don't understand this, I got something else for you. All right, there are books. You have to educate yourself. If you want to be the CEO of my life, this is what you have to do. All right, self-employment taxes, you have to pay when you're an LLC. You have to pay the employee portion and the employer portion. And so again, it's going to amount to 15.3%. Now, here you go. This is the reason why when you have just an LLC, you pay both. But if you go to an SCorp, again, we can earn the same amount of money, let's say. Let's just say we made, I'll use $50,000, right? But with an SCorp, I can say my salary was $24,000 this year. I'm going to pay tax on the $24,000 portion. But because I'm an SCorp, the other $26,000, guess what? I don't have to pay 15.3% on the tax. All right? Hopefully that gets you an idea. And by the way, don't do the Donald Trump method because I know he did this too. You cannot make $50,000 a year and then claim that you only took a salary of $8,000. All right? You can't do that. The IRS is not going to like you very much for doing that because that's not a reasonable salary for anybody. So don't try to do it. Don't try to, if your company made $100,000 and you sit up there and try to say, well, I only paid my salary under the SCorp for $15,000, they're probably going to go, okay, that ain't going to work for us. So you have to make it reasonable. Your company makes $100,000. You have write-offs of $50,000. So then you're going to say, well, okay, I made $20,000. All right, that's reasonable. You're not going to try to do $15,000, $10,000, $5,000 as a wage. You're going to have to actually be in business and act like you live somewhere, right? All right, you can't write off everything. That's another thing. That's why Trump is going to be in trouble, and this is why he never released his taxes, because he has fudged. I'll put it that way. He fudged on what he wrote off. So now it's all going to come back to haunt him when this actually gets to light, because some of the things aren't going to be allowed. All right? And I know something already that's not going to be allowed. I'll use a perfect example. Okay, it doesn't matter. This is going to come out. You have a company such as Trump.org. All right? So now you are an employee of Trump.org. Then on your taxes, you're claiming that that employee is getting consultant fees. That your Trump org is paying the person that works for you consultant fees. Okay, that ain't going to be allowed. He might have gotten away with it on the forms because when you have hundreds of forms, an IRS employee would be just like, oh, well, whatever. Somebody might do an audit, but then he's going to send all his audit team and lawyers in there to argue indefinitely. So this is what's going to happen. I'm just giving you heads up because Ivanka reportedly was sent consultant fees and she allegedly works for Trump.org. You can't kind of be both. All right? So you either work for the company or you don't. And I would say if she had her own LLC, which could be the case, that Trump.org could have paid her LLC consultant, and that would be perfectly legal. Okay? And that's probably what happened, but you can't be working for Trump.org and then sit around and go, okay, well, you paid my LLC for a consultant fee. That's going to be kind of a gray area, and that's going to be a problem because that ain't going to work. I'm going to put it that way. Because it's going to trip another trigger where they're going to go, okay, well, that LLC, you claimed you didn't have any profit, so now what? See, this is why this is going to be a house of cards is about to crumble. All right, now let's get on with it. The SCorp, as you can see, I won't get into it. I'll have a link down below. It's a TurboTax thing. And here we are. The IRS tends to take a closer look at an SCorp return since the potential for abuse is so large. Here's the perfect example. If you make $50,000 in 1 year but only designate $20,000 of that as salary income, you might trigger an IRS inquiry. See, they're talking about it right here. And that's what I was talking about. Reasonable. So their term that the IRS uses is right here. Reasonable amount of your income is wages rather than distribution or draw. All right. So hopefully you guys are still with me. You understand a little bit what I'm saying. If you don't, you can always hit it down there in the comments down below and see where we're going with that. All right. Let's see here. Now my pages have messed up. I think we got frozen. But anyhow, if a lot of you don't understand what I'm saying, I'm going to end with a book. And in fact, I'll go over here right now. This guy has a YouTube channel, Mark Kohler, and apparently my computer's freezing up. But you can go to Amazon and get his book as well. Here's the book that you can get for free with Kindle, audiobook free with audio trial, or you order the paperback version. You can go to his channel here. I'll have a link down below. Apparently it's not coming up. And we can talk about it there. Now, since I was talking about the SCorp, I guess we can get into, this is what an SCorp return, filing return looks like. L1120S. All right. And as you can see here, it's straightforward. This doesn't take any rocket science. Once you get into things, you kind of get familiar. And now when an accountant is talking to you, he's telling you, hey, what's your gross receipts? Did you have any returns, any refunds? What's the numbers? Cost of goods sold, just ordinary gross profits, net gain. So here we go. Now, look at this here. This is deductions, 7 through 21. Notice deductions, compensation of officers. See that? Remember those draws. Remember those distributions. Here we go. Salary and wages. Look at this. Repairs and maintenance, bad debts, rents, taxes and license, interest, and some of you would be saying, hey, Eric, man, I bought some T-shirts. Where does that fall under? I bought some paper and books. Well, look here. Other deductions, attached statement. Ordinary business income and losses. Now you can see how the wealthy can write things off. Notice when I use that Walmart example, look at rents. You're paying an empty building to sit there, and you're writing off $30,000 a month, $50,000 a month, and you're going to pay that lease for the next 15 years because it's a write-off against those billions of dollars we're making. And that blocks competition from moving into the area as well. All right. Now you can see excessive net income. It's straightforward. Amount owed after you take away all these expenses. Are you getting it yet, ladies and gentlemen? So this is how Trump and the wealthy get away with paying smaller amounts of taxes because they have things that they can write off. Losses. All right, let's see if any of these screens came back up. And here we go. I wanted to talk about this. This is all going to be over shortly, but I wanted to get into something because most people have an LLC. And if you have an LLC, you've heard me talk about distributions and dividends before. Corporations, C Corps, dividends. When you own an LLC, single member LLC, draw is the word. Okay, and here's what you see. An owner's draw is not taxable on the business income. That's fine, but it's going to be taxable on your personal income. All right? However, a draw is taxable as income on the owner's personal tax return. So as you can see in our example, I can write a draw against the business side. Okay, under our holding company, under the business. That's going to be a deduction, right? Under my personal, which it passes through potentially, I shouldn't confuse you. But if we're running an LLC, it's a pass-through entity without the holding company. Okay? So what I will do is I won't do a draw. I will do a distribution because I have a holding company, which is a tax write-off for my company. I haven't received a distribution, but I own the holding company, so my holding company actually has X amount of dollars sitting in it. There's two different things going on. So if I have an LLC, no holding company, I do a draw. That draw is going to be taxable, okay? Because it goes through to your 1040 tax return. If I own the holding company and I have a subsidiary underneath it and I send the dividends to the holding company, that's not my personal tax yet. So therefore, I'm not going to pay the same amount of taxes as a single member LLC that is not under a holding company. Hopefully, I explained that properly to you. And if not, you can always talk to a tax advisor or your accountant, and he'll get you straight. All right? This is why the wealthy always have holding companies. Always. And what else do they have? I don't know if this is going to come up, but I don't have it. Here's what we do next, ladies and gentlemen, the end game. I'm going to get into how you pay your parent companies and all that, but here's the end game. So you saw me have this holding company over here, right? Set up. The holding company holds assets. That's what basically goes in here. Okay? Only the assets, because if this property guy gets, if this LLC gets sued here, then if it holds the assets in here, you lose those. So therefore, the assets, let's say it's a 24-unit apartment building, the asset sits here. These are operating companies. You getting it yet? So if this is sued, you lose that entity, but you do not lose the property that's sitting in the holding company. And you have a barrier here because this is a separate entity. So therefore, they can only sue this entity and it's a wrap, but the asset is here. So therefore, you do not lose the asset. Hopefully you're getting it, ladies and gentlemen. We're not playing. Now that Trump then brought it forefront, this is how we do it. All right? And I wanted to show something else, but it looks like I lost it. All right? Because I wanted to show you that there is a tax break within, or a liability break when you set everything up as a holding company and then you have all the LLCs underneath. That decreases your liability, basically. You can only sue that one structure, that one entity. All right? So again, I'll have a link down below for all this. You guys can see it here. This article here goes over the difference between if you want to do SCorps, qualifying entities, and things like that, or a disregarded entities. All right? Or the consolidated group of companies where the holding company itself would pay taxes for all of the entities. But again, I wouldn't recommend that unless you are going to be big time and you're going to have accountants and lawyers to set this up for you. Separate entities, separate taxes for separate entities. Again, I'll have a link down below to this page. And the last caveat to this whole thing is, again, this guy is on YouTube, Mark Kohler. All right? You can go see some of his videos. This will help you understand exactly what I'm talking about. Amazon has his book that's pretty inexpensive. Used $6.95. All right. In fact, I have the book myself. I'm not selling it though. But that gives you an idea of what's going on. And I want to say one last thing, because what happens next, in case I haven't put this up here enough, what happens next? The creme de la creme is that you form a trust. Okay? You control the trust. This will be a Donald Trump staple. His whole family will have trust separately and together, because now you can move your holding company and the assets in the trust for another layer of tax haven and liability protection. All right? And I won't get into the trust factors, but a trust, a lot of people who are minorities have heard of these trusts, have heard of holding companies, but they do not understand how it protects you from taxes and how you can transfer title and transfer property to the next generation through a trust. In fact, I should have somebody on that discusses trust. So anyhow, hopefully you enjoyed this video. Hopefully you understand a little bit. If you didn't, comment down below. We're trying to help everybody here. And with all that said, thank you for watching. Thank you for listening. And please like, subscribe, and click the bell below so you get the latest updates. And I know it's hard out here. And this is why it's hard out here, because you don't get the tax breaks when you work for somebody else. You're paying that 20, 24%, 25% tax bill. But if you had a company that made the same amount of money as your W-2, except it was an LLC, you'd be paying 15.3% or less, depending on if you have losses. So anyhow, hopefully that's enough for you to get you excited to start your own LLC and be a top 10%er going for that top 1% title. And let's see you do it. And if you have any questions, any suggestions, any input into this, please put a comment down below. And with all that said, keep your head up, keep moving, and I'm out.